500,000 is all you need to live off dividends forever.
Yes, you absolutely can live off of dividends. I have many clients with less than $500,000 saved up and invested who are living purely off dividends right now at age 45 to 50. It just may look a little different than you're thinking. When you do this strategy, you can just sit back and collect dividends each and every month or quarter, knowing that you're not even touching your principal, so you can definitely just live off this forever. Once you hit this stage, you're retired. You have options. You can do whatever you want. I'm going to show you that even if you have less than $1 million saved up or invested, you can definitely live off of this with passive income. Like I said, I have many clients who have well under $500,000 invested, and they're living purely off of their investments. I'll give you the exact breakdown and some exact funds so that you can consider what might be best for you and your portfolio. My name is Nolan Gobea. My students call me Professor G, and I made this channel to make investing simplified. Johnson & Johnson pays a very consistent 2.92% dividend and has.
This is what I want, right? If we go to the year-to-date chart, this is what you want to see, right? A stock that's going up, right? It doesn't always go up in a straight line, of course. But let's see. From the end of the year to now, beginning of the year to now, it's up 24%. J&J is up 24% year to date. That is what I'm after, right? That's how much did he say?
Johnson & Johnson pays a very consistent
2.92%. So let's get the handy dandy calculator out. 24 divided by 2.92. That's 8 years. Wait, 2.92% a year or quarter?
percent dividend and has been doing
probably a year. That's 8 years of growth, 8 years of dividend income that you got in the span of 8 months, right? That, in my opinion, is where you need to be putting your focus on, right? Find those assets that are increasing in value. Buy the stocks as they're crashing up, not as they're crashing down. And then when they crash back up again, that's where you need to be investing your time. That's where you need to be investing your resources. Elsewise, bro, you can literally go to SGov. It's paying over 4% APY, over 4% APY with zero market risk. This is the iShares 0 to 3 month Treasury bond ETF with, I shouldn't say zero, next to zero market risk. And you can get 1.5 times what J&J is making.
So for well over 60 years. One can realistically assume that this is going to continue. And not only is that going to continue, the dividend's actually going to continue to increase because each and every one of those years for the past 60 plus years, they've been increasing their dividends. The problem is that even at $1 million invested, a 2.92% dividend yield will only
It's going to give you like $29,000.
get you about $29,200.
Look at that. Chris can do math. Although yesterday I totally botched it on the calculator.
Per year. You likely aren't living off of just purely that. Now, a slightly higher dividend.
But hear me out. If the stock is up 24% year to date, that $1 million has now become, I don't know, let's do the math on here. 1 milli times 1.24 gives you, wow, $1,240,000, which is like 10 times higher gains than this dividend. I would okay, put it in the chat. If you're watching on the replay or if you're watching live, type milli if you would much rather have your $1 million gaining 24% than your $1 million paying you 29% over the year. Type milli. I don't care how you spell it. M-I-L-L-Y, M-I-L-L-I, M-L-L-L-I-E. Doesn't matter, right? That is where we need to be focusing our attention. Let's go back to J&J. Is asset growth, asset appreciation, not the trickles, not the pittance.
He has consistently had a 3.5 to 4% dividend for the life of the fund. Both of those options are very low risk.
Again, SCHD, let's do a side by side. So on the left-hand side, we're going to SCHD. On the right-hand side, we're going to put SGov. I don't want to change interval. I want to go to SGov, SGOV. Now, the chart's going to look weird on SGov because what it does is it accrues interest on a daily basis, and then it pays out that interest, and that's why it looks like this big wave over and over and over. SCHD, however, got absolutely dominated earlier this year hang on. This is year to date. So year to date, SGov is down. Year to date, SGov is down 1.56%. At one point in time, SGov was down over 14%. I'm sorry, not SGov, SCHD. This year, SCHD was down over 15% at one point this year. Whoa. Okay. Well, praise Jesus. We finally got it back. Now we're down only 1.64%. Goodness gravy. I have no idea what happened to this. If you know what happened, let me know in the chat. That's unbelievable. Hang on. Rick is saying turn on just. It looks exactly the same. Professor G is obviously not an outlier. SCHD had a reconstitution. It definitely had something. Oh man. Tariffs killed SCHD. That is unbelievable. Right? So you're excited to earn how much?
Risk for your 4% dividend for the life
3.5 to 4% with, now this is the important part. Follow along with me. Okay. Everybody pay attention. Earning 3.5% to 4%, which is not consistent, nor is it safe when you have a potential 15% pullback. This is crazy. So this has market risk. This has a giant amount of market risk potential, and it showed up in 2025 how bigly that market risk can be. And then for the same income, for the same dividend yield, you could go over to SGov, as I mentioned earlier, which is 0 to 3 month Treasury bond ETF, which is exactly where I put my cash. And you'll see, like, I know it looks crazy with the ups and the downs, but this is the interest being deposited into your account every single day. It pays the dividend and it goes down by the amount of the dividend. But look at how consistent this is. Right? It stays around 100 always, because that's how it's set up. This is oof. I may rage quit this video, but let's see.
life of the fund. Both of those options are very low risk for your
My account's getting lower, but I'm getting paid dividends. Right. That is this. Right. You're giving up the flood for the drips. Man.
portfolio, and solid blue chip or solid ETF investing that can definitely be counted on forever. There's no reason why we can't assume that it's just going to keep going. Plus, you're
Did anybody else hear that?
probably, there's no reason why we can't assume that it's just going to keep going.
I have a fundamental huge problem with this. This feels the most dangerous word in finance.
Probably growing, but also the actual principal that you have is going to grow each and every year.
Is it? Is it? It did for sure with J&J. That was a great stock pick, but it's certainly not growing if you're an SCHD.
These ones also pay a qualified dividend, which is very important, and I'll go over the taxes in a little bit because that's very important for you to understand if you are ever going to try to live off of dividends. The problem, obviously, with these two first options is that unless you have $2 to $3 million saved up or invested, you likely aren't going to be living off of something with a dividend at 4% or lower, at least purely or primarily. Next, we have the options of higher dividends from higher dividend paying stocks. We have a higher dividend paying company like UPS with a 6.13% dividend, or UPS with a 7.47% dividend.
UPS got a lot of attention. I saw on Reddit the other day. Oh my good gravy. Let's go to year to date. Wow. Anybody see a problem here? All right, year to date, UPS is down. Oh my gosh. UPS is down 30.02% year to date. But at least you're getting that 1.9% per quarter. Wow. Would tell me in the chat, how happy would you be if you're incredibly intelligent, probably super handsome, incredible hairline, financial advisor, told you, I'm going to put you in UPS. It's a super safe stock. People are always buying packages. UPS is never going to go out of business. This is a long-term play. And you know what? We're going to start investing on January 1st. And it pays a 7.47% dividend. Fast forward to September, you're down 30% on UPS. You'd probably be pretty pissed like Anthony or Ian or Ryan L. You'd be bigly unhappily. Yes. He would be fired. I told me I hate me. The wife isn't happy either. Moneybags Ashley would be hella pissed. I don't know what Senior Wahoo's GIF is, but it didn't come through for some reason. UPS stock is just as good and accurate as their tracking. That's a good one. Dude. And yet people fall for this scheme that dividend investing is so smart and so brilliant. Okay. Remember, the objective here was to have $500,000 work for you. Now, I know we're picking on UPS as an example, but this is why finding a stock that if it pays a dividend, that's a bonus. But you need to be looking at it as capital appreciation, capital growth here, not just throwing something into a pile and saying, you know what, pays a dividend, by all means, let's do it. It would be equivalent to, I like to use my Texas Roadhouse analogy. It'd be equivalent to buying a rent house in a city where the Texas Roadhouse just shut down. Okay, it just shut down. Now, the neighborhoods are getting older. They're actually closing schools because there's less children, and now the home values are going down, and your rent house has gone down by 30% in value. But hey, you're still collecting that rent, right? We're not talking depreciation or any other accounting things. We're just talking about pure value. Hey, you're still collecting that, $750 a month, even though you've lost $300,000. Cheapers creepers, right? So you took your 500,000 that Dr. G was talking about, and you multiplied it by 0.7. So now you see the problem here. I'm down 150 grand. I'm down 150 grand on this stock, but it pays a 7% dividend. So let's say we got our 7% dividend on the 500,000. I'm down 150,000 on my asset value, but I'm up 35,000 on dividends. I'm good. I'm clear. Everything is great. Yeah. Right? Once you talk numbers, it changes things. This is brutal. We're 2 minutes and 58 seconds in. I don't know if I definitely don't think I'm going to make it through this video.
Dividend, or Pfizer with a 6.79% dividend.
Oh, let's look at Pfizer. Don't tease me with a good time. Tease me with a good time. This is year to date. Okay, Pfizer, not so bad. Pfizer, not so bad. Year to date, down at least 20% at one point. Now it's down only 2.4% at one point. So therefore, you are net up potentially around 4% on Pfizer. Cool. Definitely worth the dividend.
Dividend yield. And then we also have higher dividends from REITs. A couple solid REITs are O, Realty Income, with
Oh, now we're talking, right? Now we're talking. This is what you're after. This right here is what you're after, right? The asset is growing in value, and you get a bonus of
with a
5.47%. So you're up 13% on the stock itself, plus an additional 5-ish%, give or take. That's what we're talking about. That is what you're looking to do. Okay? Not throw it in a stock that has a high dividend and just disappear. You want to find stocks that are appreciating in value, hold them for as long as you can that fits in your trading plan. And then if they do pay a dividend, by all means, take the dividend.
7% dividend yield, and then VICI with a 5.33.
Again, another good example of what a good dividend paying stock should be, up 19% with an additional 5%. That is bonus money. That's bonus money. Think of this as your job. If your job is to be in stocks that are winning, you can get paid your monthly salary. And then if you do it right and you're holding on to it, you can get a bonus for having done the right thing. There you go.
3% dividend yield. REIT dividends are usually taxed as ordinary income, not qualified dividends, which may result in higher tax bills unless held in tax advantage accounts like IRAs or 401ks. I'll go over taxes in a second because, again, that's going to be very important for you to understand this. The next type of strategy that people are absolutely using to live off of dividends is actually one that I'm seeing very, very heavy right now, because you definitely don't need anywhere even close to $1 million to actually live off of these types of dividends. I'm going to go over my favorite strategy here, but first, let me introduce you to my favorite cup of coffee, by the
Oh,
awesome sponsor of this video.
all right. Dr. G's being sponsored by his coffee company. Very cool. Batman Coffee Company. It's saving Gotham City one dark night at a time.
Dividend assets. My favorite solution is the covered call ETF. These would be ones like JEPI or JEPQ, QYLD, QQQI, SPY-I, and many others. A covered call ETF works like this. The ETF holds a portfolio of stocks like the S&P 500, NASDAQ 100, or a different specific sector. It then sells call options on those holdings to generate income. The premiums collected are distributed to investors, often as monthly dividends. One thing to keep in mind is what I
Okay. That sounds great. I like that idea. Spy Eye. Why is it? I don't want it in futures. Hmm. Now we're talking. That year to date. And now we're talking. Now, granted, it definitely had some sell-offs here, only down 15%. But as of right now, it's up around 8.4%. Plus, you get a dividend on top of that. I guess because they're selling covered calls on the SPY. I mean, I can get on with that. But again, right, when it has a stock that is crashing up versus crashing down, that'll make all the difference to you.
talked about earlier, and that is you need to understand how that dividend's actually
It is black as night, my friend. Black as the dark night.
being taxed, though. It'll be classified either as a qualified dividend or as an ordinary income dividend. If it's classified as a qualified dividend, you're going to be taxed at long-term capital gains rate, which is very favorable. This will usually be around 15% for most, which is very low for investment income. If it's classified as an ordinary dividend, it means it'll be taxed at your income level. So if you're a high income earner and already have like a 30% income tax, your dividends will be taxed at 30% or higher if it pushes you to a high income bracket. If you're investing within an IRA or a retirement vehicle, then you don't really have to worry about this. But
Which I do, and I highly recommend you do as well.
for most people that want to retire early, they're usually investing in a taxable brokerage because you can touch that before age 59 and a half. And so you do need to keep this in mind. For most of the lower style dividends, things like SCHD or even blue chip individual stocks, most of those are going to be qualified dividends, but definitely check that out. For most REITs and most covered call ETFs and anything really that has a higher dividend, 6%, 8%, for sure if it's in the double digits of dividend percentage, you can likely assume that a portion, if not all of that, is going to be taxed at ordinary income. That's kind of usually the catch there. So you definitely want to look into that when weighing in your options. Another thing to also look for is this thing called ROC, or return of capital. In covered call ETFs like QYLD, JEPI, BTCI, part of the monthly distribution is often classified as return of capital. ROC is not income or profit. It's essentially giving you back a portion of your original investment. It reduces your cost basis, which is
Oh, look at that. I'm learning. I actually am learning something here. This is cool.
the amount you paid for the ETF. So one covered call ETF that's very interesting right now is BTCI. The dividend yield per year is in the high 20s up to 30%.
Oh, good gravy. Okay. That makes me That sounds unbelievably amazingly huge. What's the catch?
This one has a higher dividend for a couple reasons, but also it's quite volatile and risky.
Well, it's quite volatile. Okay, let's see. BTCI. Um oh it's a Bitcoin. Oh, it's Bitcoin related. Okay. Yeah, no joke that that's got a lot of volatility. But it's up nicely year to date. Let's see. It's up 22% year to date. Risky AF. I watched this guy's videos until I found Chris. Oh, Ryan, that's sweet. I was watching his videos till I found you, Ryan.
Because the underlying asset is Bitcoin. But if you look here at the fund description, it says that up to 96% of the distribution is considered ROC. To give you a better visual here, here's a super generic example with oversimplified numbers. You buy 100 shares of BTCI at $60 each. That's a $6,000 cost basis. You get a $3 per share ROC distribution, which is $300 total. Your new cost basis now is $5,700 or $57 per share. When you eventually sell, you'll owe capital gains tax on the extra 300 since you already got it back tax deferred. In short, return of capital from covered call ETFs equals tax deferred cash flow now, bigger capital gains bills later. So ROC in the short term is definitely better than something like an ordinary dividend, because if it's an ordinary dividend, as you get that money, say it's $500 per month, if it's ordinary, that gets added to your income. So it looks like you just made more income, so your income tax will go up, obviously. With ROC, it's not added to income specifically, it's not looked at in the same way. This just looks like you're being returned your capital, so you're not being taxed at that point, but down the road when you sell the asset, you will have capital gains.
Not gonna lie, that sounds cool. Very cool setup on that particular type of investment there.
Tax. In general, we want to find something that defers the taxes or eliminates them altogether. Some great covered call ones in the category that I've liked recently are SPY-I, QQQI, QYLD, and BTCI. Then the last strategy within this passive income idea to be able to live off of passive income is the idea of these super high yielding funds. And as of right now, they're all the rage. A bunch of YouTubers have definitely made very cool looking videos on these very high yielding style funds. But at the end of the day, they're very risky and you gotta be careful. The most famous right now are yield max funds. Some notable names are MSTY, NVDY, and ULTY. The Yield Max MSTR option income strategy ETF MSTY has a trailing 12-month dividend yield of 161.12%. Its current dividend yield is 132.08%.
Hold on. Something smells really fishy about that. How could it possibly be that high?
Per year. That's just insane. But really, is that not a red flag? NVD
Mm-hmm.
ULTY has a trailing 12-month dividend yield of 81.04%. ULTY has a dividend yield of 124.36%. The big issue here that I'm seeing, and I'm not sure why not everybody else is seeing this, is that the NAV, the actual price itself,
You mean this part here? You mean that part there? The net asset value? Okay, sure.
just absolutely erodes like crazy with these types of funds. Like this year, MSTY is down about 31%.
I don't know about that. I mean, maybe. Oh, there it goes. There we go. Adjusting for the dividends there. Okay. Year to date. Let's move this over to the beginning of the year, right there. Now, down 43% now. Let's do this side by side with UPS. Okay. So on one hand, he's saying, "Oh, this is bad because it goes down in value." but he's not saying this is bad because it goes down on value in value. I mean, they definitely are different charts. They definitely have different slopes, but at the end of the day, they're doing the same thing here. But one of these is great, and one of these is a bad guy. Yo no comprehendo.
Negative 31%, NVDY is down 35%, and ULTY is down 49%. For example, ULTY losing about 50% of its NAV, you could have put $100,000 in a year ago, and now your $100,000 is worth $50,000.
How is this different from the UPS example?
Yes, you receive dividends on that all year, but how long can you keep your money in that if it keeps going down by half?
Did we not have this conversation a little bit ago? Did we not just go through this on stocks like UPS, right? It's a bad stock. Remember, all stocks are bad, but every once in a while they act right. UPS is a bad stock. Why is this one a badder stock? I don't understand. Yes, we did do this.
Pretty soon you're not going to have any money in there to receive dividends on. Many of these have very, very high expense ratios, over 1% for sure, and so you got to be careful with that because that's eating into your profit as well. I wouldn't touch the yield max funds at all, and I definitely don't, but if you do, you definitely want to stay active on them and start getting out of them as soon as you start seeing that NAV erode way too much. So many just want to go straight to that covered call ETF strategy because it's not as risky as that last one that we just showed, but it's also not super small dividends like the first couple of strategies that I was talking about. Yes, you could get there pretty fast using the covered call strategy, but the problem for me is that there's not a lot of history with these funds. They've been around for 3 years, some of them like 5 years. That's really not enough data. They haven't gone through enough market cycles for me to be able to say it's smart to hold these forever. And when we're doing a dividend investing strategy,
Bro, you don't need to hold anything forever. Nothing forever. Not anything forever. All stocks are bad, but every once in a while they act right. Let's look at Apple. Who remembers, Pepperidge Farm remembers, but who remembers when Apple couldn't go down? I remember that. That was back in my Chris Sells Calls days. It was probably over here. No, it had been before that. Apple couldn't go down. It only went up. Oh, yeah. It only went up. Is that the case now? I wouldn't say so. It's basically flat since July of 2024. So over an entire year of zero gains. All stocks are bad and every once in a while they act right. Let's go to AMD, right? AMD has acted really bad for a long time and really good for a minute. Okay. Amazon acted really bad for a minute, then acted really good. Every stock is like this. Celsius, good my goodness gravy. All stocks are bad, but every once in a while they act right. You should never plan on holding any stock forever. There's just no reason. Look at Google. Right? Now, I know some of you are going to say, but look, Chris, in the long term, it's going up. Up, baby. Yeah, but let's also take into account the drawdown here of 20% back to even took you 120 days. This drawdown of 31% back to break even took you 142 days. So imagine during this drawdown period of cumulatively, let's call it 300 days, give or take, you invested somewhere else for 300 days that was going up, then you could have even more monies. Am I oversimplifying this? Yes, on purpose. But all stocks are bad, and every once in a while they act right. So I don't want you to ever feel like you need to buy a stock forever and just hold it forever. Like tie your identity to it. I see a lot of people who make videos on the YouTubes, and we show some of them who like their entire life is wrapped up around what a stock is doing. First off, we have no control over what the stock is going to do. Second off, Just buy the stocks as they're crashing up, get out of the way as they're crashing down, and use the outlier trend template, the 10 over 20, price over 50, to determine when that's happening. And the rest of the time, sit in cash and don't F up your portfolio. It is so easy to do. So easy to do. But if you just sit in cash and earn 4% APY on something like SGov, at least that's what's paying, around this time, around the time you're watching this. Who knows what it'll be by the time you actually watch this later. Then you don't have to worry about those dividends because you're in cash. And then when you find a new opportunity for a stock that is working, you can go into it. And then when it's done, you can go back to cash. So either way, I have no idea what I'm talking about. I'm just a random guy on the internet, but I'm trying to help you save time, make money, and start winning with less risk. You should watch one of these two videos to learn more about how to do that. We'll talk soon.